Okay, this video, is all about the economic costs of multinational corporations. So I've discussed some of the benefits that they can provide. This is looking at some of the negatives that they can provide for both developing and developed countries. One negative of multinational corporations is that even though they pay tax in that company, often the profits that they generate will be repatriated or returned back overseas to the country of origin. So the problem is that if we have more multinational companies, or we allow foreign companies to start taking over more and more Australian companies, there's going to be higher debits in the net primary income section of the current account as money flows back overseas in the form of profits and potentially dividends overseas. So that's one negative, is the negatives that can have on the current account, and then our future level of debt because of our high level of current account deficits. So it is important to recognise that this net foreign equity can lead to more net foreign debt in the long term if too many profits are flowing back overseas as well. Some observers claim that the high level of power they have can mean that they hold countries to ransom, which basically means that they can negotiate so they pay less company tax. So that's the case with Apple. They often don't pay the right amount of tax that they should be paying, and that can lead to problems for the country that they're in because they don't get the tax that they deserve to. Often a lot of these multinational companies will keep the sort of the top-end managerial positions for people from their country anyway. So rather than trying to develop the skills and develop the training of workers in that country, they'll just bring over people, and most of the high-paid jobs will still stay with the people from the country of origin. And this can lead to developing countries remaining sort of trapped in a cycle of sort of low-cost, low-skilled work, and widen the income distribution in poorer countries. So a lot of the top-end positions get kept by those from, might be America, but they're in Ireland, and therefore a lot of the Irish people don't get access to the skills and training that they need to develop their skills and become high-end managers and things like that. If labour costs increase in developing countries, they'll often move offshore, so they might establish themselves in a country, and then labour costs might increase in that country, and then they'll reduce their investment, and that will lead to a rapid increase in unemployment in that country. So for example, if you set up in China and then wage rates increase in China, they might move to Bangladesh or Vietnam or something like that, and then that will cause a lot more unemployment in that country as well. Another problem with multinational companies is they can lead to the local companies becoming less competitive and going out of business. So if there's similar companies in that country, if you're trying to compete against McDonald's, for example, and you're a small cafe, that can lead to people losing their jobs because they can't compete in terms of local businesses. They can't take advantage of economies of scale, and therefore they can often go out of business. Many multinational companies are also capital intensive due to poor skills of local labour, so they often don't promote employment because they use a lot of machinery. While pay may be higher, working conditions are also often poor, and multinational companies can take advantage of extremely long hours, which can reduce the non-material living standards of workers. So we looked at the Nike example. That can be a negative because they're taking advantage of workers and hurting their non-material living standards. There's also been incidents of unsafe work sites and deaths within certain companies. There's a very famous example of a company working out of Bangladesh, where a lot of people died because of unsafe work practices within Bangladesh. And finally, companies have been involved in transfer pricing, where they have basically shifted the profits offshore and therefore have cost the government millions and millions of dollars because they've transferred money to like a subsidiary in like the Cayman Islands or something like that to reduce their amount of tax that they have to pay. So there are negative economic implications from these multinational corporations that include things like transfer pricing, the fact that working conditions are often poor, that they can hurt local businesses, that they don't often develop the skills of the local workers because the managerial positions are taken up by people from the host country. They often can negotiate to pay less tax, and one of the main problems is the amount of profits that flow overseas, hurting our current account deficits as well.